Ladies and gentlemen, good day and welcome to the Finkurve Financial Services Q3 FY26 earnings call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Smith Shah from Adfactors. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on the Q3 and 9M FY26 maiden earnings conference call of Finkurve Financial Services Limited. We have with us the company's management team. Before we begin, I would like to remind you that certain statements made in today's discussion may be forward-looking in nature and may involve certain risks and uncertainties. A detailed statement in this regard is available in the Q3 and 9M FY26 investor presentation that has been uploaded on the stock exchanges. I now hand over the call to Priyank Kothari, Executive Director, to begin the proceedings of. Thank you, and over to you.
Good morning, everyone. Welcome to Finkurve Financial Services' first formal earnings call. Thank you for joining us today, especially those who are engaging with us for the first time. For context, Finkurve is a part of a promoter group with a long-standing presence in the gold ecosystem through Augment. Over several decades, this has translated into deep experience across gold sourcing, distribution, and risk management, and a very strong understanding of the discipline required to operate responsibly in business linked to this asset class. At the same time, Finkurve is being built as a fully independent lending institution with its own governance framework, risk architecture, and operating discipline. We see ourselves as a next-generation, technology-enabled gold loan NBFC, where technology is used thoughtfully to improve efficiency, scalability, customer experience without compromising on risk controls. Our integration with the broader Augment ecosystem gives us a unique structural advantage, particularly in areas such as gold handling expertise, process design, and institutional understanding of this asset. This allows us to compete effectively while remaining firmly anchored to prudence and strong credit discipline. While Finkurve is distinct in its structure and operations, it is being built with the same underlying ambition that has guided the group's businesses over time to create institutions respected for execution quality, governance standards, and long-term consistency. Our objective is not merely scale, but to build a trusted gold loan franchise that leverages technology and experience to deliver sustainable growth for customers, lenders, and our investors. Briefly touching upon the operating environment, gold prices have remained elevated over recent periods, reinforcing gold's position as a trusted store of value for households. This strengthens the collateral backing of gold-linked credit products and supports prudent, secured lending when underwriting remains conservative. At a broader macro level, from a market opportunity perspective, the gold loan industry in India continues to evolve structurally. The organized gold loan market has expanded meaningfully over the past few years, with industry outstanding now exceeding over 15 lakh crore, yet this still represents only a small fraction of gold held by Indian households. Importantly, we are witnessing a shift in borrower behavior, with gold loans increasingly being chosen as a preferred form of short-term borrowing by customers who may not have historically accessed this product. It is driven by ease, transparency, and speed of disbursement. Additionally, recent stress and tighter underwriting in certain unsecured and microfinance segments have reduced credit availability for a section of borrowers, further reinforcing the relevance of secured credit solutions. At the same time, ongoing household accumulation, particularly in Tier 2 and Tier 3 markets, continue to expand the available collateral base. In this environment, conservatively structured, well-governed gold backing lending remains well-positioned for sustainable growth. From a strategic standpoint, our approach to growth is separate and measured. We are scaling the business at a pace where systems, people, and control remains firmly ahead of growth. We are consciously avoiding growth driven by aggressive pricing, relaxed underwriting, or short-term balance sheet optimization. Our belief is that consistency and resilience matter far more than headline growth numbers, especially in a secured lending business. From the outset, we have invested in technology, processes, and control frameworks that are appropriate not only for our current scale, but also for where we aspire to be in medium term. Governance, compliance, and risk management are being institutionalized as core strengths rather than treated as reactive requirements. As the business scales, we are also mindful of our evolving regulatory framework for NBFCs. In due course, including as we approach thresholds that would place us in a higher regulatory layer, we are proactively strengthening our governance and compliance preparedness. Our objective is to ensure that any such transition, when it occurs, is smooth, well-planned, and instills confidence amongst all stakeholders. Before we move to the financial performance, I would like to briefly clarify our approach to guidance. As this is our first earnings call, our intent is to provide directional clarity rather than precise numerical targets. As the business matures and performance stabilizes, we will progressively enhance the level of guidance we provide to the market. With that, I will request our CFO, Akash Jain, to take you to the financial performance for the period. Post that, we will open the floor for questions. Thank you.
Thank you, Priyank, for this opportunity, and good morning, everyone. This is Akash Jain, CFO of the company, here to present the business numbers of this previous quarter, Q3. Our AUM, as you can see, AUM has grown by 118% from 381 crores to 833 crores, which also includes some bit of off-book, that we have it for gold loans with our banks. Our branch network has grown from 72 to 98 branches. Our income, on the income side, we have grown by 31% year on year, and on the PAT side, our PAT has grown from by 18% quarter on quarter and 24% year on year. Our NPAs, is something that we are very, proud about, because we have been able to maintain our NPA levels sub 2%, whereas the industry has been hovering around 3%. Our ROA and ROE is something that we are really working on. Currently, because of our low leverage, our ROE is somewhere about 8.5%. It's anywhere between 8 to 9%, and ROA is somewhere about 3.5 to 4%. These are the broad numbers of ours. Now I'd like to open the floor for question and answer.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Rao from NVS Brokerage. Please go ahead.
Hello, sir. First of all, very congratulations on the great set of numbers. I have a couple of questions. First is about your capex plan over the medium term. Second would be that since gold loan now accounts for over 90% of the loan book, do you intend to remain a pure play gold NBFC, or do you see selective diversification into lending segments? And I understand, sir, you have said about providing no guidance, but anything on revenue, profitability, margin, or asset quality trajectory over the next 2 years, sir? Thank you.
Good morning, everyone. So this is Naveen Kotala, CEO of Finkurve Financial Services. So I'll break your question into three parts. So regarding the capex plan, we have a steady growth in terms of our annual operating plan. So last year, since YTD till date, we have grown around 26 branches till the quarter end, and we continue to grow in the similar fashion, similar phase, and we continue to remain, the growth will be restricted to profitable growth. We will never go aggressively on the growth front. It will always be risk adjusted growth. In terms of portfolio mix, we wish to remain as a gold NBFC in next 5 years. We want to have this differentiation intact. We will diversify only to only in terms of portfolio mix, and risk adjusted return, but primarily focus will always be gold loans. Okay. And what was the third question?
Revenue type margin, any sort of numbers.
What was the third question? Can you ask again?
Yeah, so as you said that no guidance is provided of numbers, can you direct some directions about stability, asset quality for next 2-3 years?
I'm sorry to interrupt, ma'am. You're not quite audible. Could you please, change your position or something like that?
Am I audible right now?
Yes.
Yeah, you're audible.
Please go ahead.
Okay. So, as you have already said that you will not provide any guidance on numerical terms, but I wanted some, 2-3 years outlook for asset quality, for revenue or margins, because the growth is right now very high. It's very good, actually. So, can we expect this to continue, or how is it? Something on that.
So the current growth which you are seeing is on the back of low base, as well as a bit of operating leverage kicking in. So we mentioned that we will not give any guidance because we are currently in the growth phase. So correct. The numbers will look very very different if you compare it with any steady state company. So any guidance on growth will not be will not be valid, because on a short term the numbers will not will not make a lot of sense in terms of if you compare it with a steady state company. But we continue to, so last year on the AUM front we grew approximately somewhere around 100%, but we will continue to grow with a bigger base. We'll continue to grow somewhere around 40 to 50% growth. So that we can expect to grow in that range, provided all the external factors as well as our internal operating plan stays intact.
Okay. Thank you so much, sir.
Thank you. The next question comes from the line of Suraj Shinde from Yes Securities. Please go ahead.
Hello. Am I audible?
Yes.
Thank you for the opportunity. So first question on the hello.
Suraj, please go ahead with your question.
Yes. So my first question on as you highlighted, a centralized take-lead operation platform with AI-based control and monitoring. So just wanted to understand from that perspective, from a practical standpoint, where have you seen the biggest benefit of that initiative?
Suraj, you're not clear. Can you please come again?
Suraj, you're not audible. Could you please use the phone on handset in case if you're on speaker, and please change your location. We move on to the next participant, that is Urmish Shah from Money Wisers. Please go ahead.
Yeah. Hello. Am I audible?
Yes.
Yeah. So my first question is, we have seen a contraction in NIMs. I do understand we are on an expansion phase, but I fail to understand the reason, because it's kind of a bit of a sharp fall, because our collection efficiencies were also quite maintained. So could you give any reason? some color on NIMs?
So hi, I would answer this question. So the contraction in NIM that you see is on account of the operating leverage or the leverage that we are having it in our capital. Previously, our capital base was very good. Our CRAR was above 50%, and the leverage was less than 1, right? Currently, as we speak, year-on-year basis, with the equity infusion that we have done of 111 crores in May, our leverage has also grown to 1.67.
Right.
So with the increasing finance cost, yes, you will see that where the industry is somewhere about 11-12%, we are at 15%. We are still high, and once we are at an industry average leverage of 3 to 4x, I think you will see we'll be somewhere about in the industry range of 11 to 12% of NIM.
Okay, so this may further contract as we are going on an expansion phase. Is that what you are implying?
Yeah.
Okay, and in terms of key ratios also, as you mentioned, CRAR was at 50 and now it's at nearly 40, and our leverage also will increase. So
correct. So with increasing leverages, all of this will fall in place with on a comparative basis with our peers.
Okay, sir. Thank you. Yeah.
Thank you.
The next question comes from the line of Suraj from Ace Securities. Please go ahead.
Hello. Good afternoon, sir. Am I audible?
Yes, you are.
Hello. Yeah. So just wanted to know, as you highlighted, a tech-based centralized AI platform. So just from a practical standpoint, I want to understand where have you seen the biggest benefits of this platform, like in terms of faster TAT, lower fraud, or better customer retention? One is on that front.
Yeah. So technology and AI is primarily used in 3 aspects. One is risk control, second one is customer experience, and third one is operating efficiency. So these are the 3 things where we are using technology. So when we say technology first NBFC is primarily improving these 3 areas, and as we grow, we will grow much more efficiently compared to our peers who have grown in the era of non-technology and as well as non-AI times. So that is the primary benefits we will get during our scale journey.
Also, just to add, we have already begun building on the foundational data and process architecture required to support automation. We're working on a lot of automation when it comes to processes that will eventually help us to be the best in terms of turnaround times. So wherever we identify a repetitive or a manual heavy process, whether it's operations, reconciliations, or reporting, we're using AI to automate those kind of functions as well.
So, sir, as you mentioned that, and we are also seeing in your presentation that as far as your branch network is scaling up, so what are the incremental tech-based investment that you require to put in the system? And also, can you quantify the amount that you have required for the same?
So please go ahead.
No, I'm sorry, I couldn't get your question. Can you please repeat that question?
So basically, has the branch network scale up going ahead? So what are the incremental tech-based investment that you require to put in the system?
Okay, so see, our tech stack is completely in-house built. So incremental tech cost is not there because the tech cost is the investment in tech is already done. Okay, so for branch expansion, the incremental tech cost will not be there. However, we keep on investing in risk controls, operating leverage, as well as customer experience. So those will keep on evolving over the time. But per se, expansion will not lead to an incremental tech cost. Okay. In terms of guidance on what is the exact number, so those we can, we don't have that ready as of now. We will mail you in the future course of time.
Okay. So last question on this collection efficiency that you have mentioned in the presentation, 94% average collection efficiency that we saw during this quarter. So this collection efficiency you saw across all the state, or do you find some state there is a difficulty while in collection? Is there any kind of thing in the state of Karnataka, Tamil Nadu?
No, so there is no defining trend in terms of state-wise numbers. So it is usual business as usual for all the states. So we don't have any spiking trends or things like that.
Okay, sir. That's it from that. Thank you.
Thank you. The next question comes from the line of Rahul Kumawat from Wind Wealth. Please go ahead.
Hi everyone. This is Rahul. Am I audible?
Yes, Rahul, just be a little louder, please. Thank you.
Yeah, sure. So my question is majorly from a industry standpoint. So seeing the current industry growth, is this kind of growth be sustained in the near future, or let's say 5 to 7 years?
See, so growth has happened on two factors. One is that we're seeing a lot of borrowers coming from different segments choosing gold loans as a preferred choice. So one is that market overall has increased. Second, it's important to basically reflect on the fact that price rise has also helped gold loan institutions to increase business. So when you're talking about 5 to 7 years, there are two components. One is our ability to attract new customers will be a very important factor, which we are pretty much confident about. Second is a very important level, which is of course your price. Price at an overall level helps us to increase business also. So these two are important factors that will come into play to understand probably in the next 5 years as to how the market basically evolves when it comes to gold loans.
And also, what are you guys planning for attracting new customers? Like, I think there are so many players in the market. So what is your competitive strategy in this kind of market?
Yeah. So we always believe in faster service as well as markets where a competition is not able to serve properly. So two things. So the market is largely still unorganized. So that shift is happening. It will keep on happening for quite some time in the coming future. So even though there is good competition, we also believe that in this business, more than demand, operational excellence matters more than so execution capability matters more than the demand factor. So we are strengthening our execution capability as we are growing slowly and steadily. So we believe that we will be able to give a lot of a better customer experience than our peers. That will help us in the long run. With respect to demand, the demand is ample enough to survive a large number of players, even though there is competition from the outset. You can see that.
Yeah, sure. Thanks. This is from my side.
Thank you. The next question comes from the line of Prisha Shah from Family Office. Please go ahead. Prisha, please go ahead with your question and kindly unmute your line in case if you're on mute.
Am I audible?
Yes, now you are.
Okay, I have, hi sir, good afternoon. I have couple of questions. Firstly, on our gold under management grew meaningfully but at a very slow pace. than the consolidated overall AUM. So is it largely driven by the high ticket sizes, or is it just the LTV movement, and do we expect this trend to continue from here on?
Can you repeat your question?
Yeah, sure, sir. So, sir, my question was, our gold under management has grew meaningfully, but it is slightly at a slower pace when we compare it to our consolidated AUM. So I just wanted to know, is it largely driven by the higher ticket sizes, or it is just the LTV movement? And do you expect this trend to continue from here on?
So the AUM growth has been on the back of two things. One is customer expansion, branch expansion, as well as price growth. So all the three factors combined, contributed to the AUM growth. So out of these three, only price is not in our control. So rest other things, it only depends on how good we execute, how good we expand. Okay, so those things will remain as it is. Price growth is naturally not in our control. Even if it doesn't happen, we have our operating plans in terms of how we grow. So you may not see a very large growth, because last year's growth was also on the back of low base. So this year we will have a decent base. So growth will definitely on the back of these new factors.
Okay, sir, understood. So I just have one more question. The AUM has also been doubled on Y-on-Y basis. So how much of this growth is coming from branch expansion versus the higher productivity per branch, and how should we think about the sustainable quarterly AUM growth from here?
No, so AUM growth is, so as I explained earlier, so AUM growth is on back of all the three factors. So going forward on quarter, as I explained earlier as well, right? So only the price factor will not contribute, and that is unknown to us. So remaining other things will work as it is. So if you look at our average AUM per branch, that is also continue to grow. Okay, so
to answer to top to what Naveen said, so growth has come from two factors. 50% is of course coming from new customers, and 50% of the growth has come from price rise also. But price rise is something that we do not factor in our annual operating plans, because that is unknown. So all our efforts, whether it is in terms of expansion of branches, attracting new customers, it is taken into consideration wherein we estimate or we have our plans wherein price will not increase. Right? So all our plans are made on the fundamentals that price will not increase. But of course, the way prices have increased in the past few quarters, this has helped the business to grow even faster.
Okay, so just a follow-up on that. So as we are looking to double down our AUM from here, so what are the operational metrics that you will be prioritizing, most to ensure this growth which should be coming in does not dilute the overall customer experience or our asset quality?
Yeah, so we have so there is nothing new than what we were doing till date. So the metrics remain the same in terms of your AUM growth, in terms of your tonnage growth, in terms of your customer growth. So operations, for the operating standpoint, there is nothing changing. It is the same thing. It's just that with the increasing base, we will get operating leverage. That is the only thing which is changing. Metrics will remain same as we used to track last year. We will be tracking the same metrics this year.
So with that, what Naveen said, just to give you a little more clarity, there are 2-3 more important things that we want to focus on. We are a well-capitalized company. Our major important metric to leverage on is our leverage ratio. If you see, our leverage right now is 1.67. Our next goal and target is to be at 4x. Right, so there is significant headroom for us to leverage, which will eventually lead to expansion in AUM. Right? So that is a very important metric for us to get to in the near future. And other than that, we've been very clear since the beginning that we do not indulge in discounting business, wherein we do not lend or offer low-yielding schemes to our customers. So on that front, we've been growing well, also in terms of our ROI, wherein which is the rate that we charge to our customers has been very healthy, around 19.5%. Right. So these are few important principles and fundamentals that we follow at Finkurve, and I don't think anything will change, with respect to those numbers in the near term.
Thank you so much, sir. That answers my question, and all the best.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Our next question comes from the line of Rohan, an individual investor. Please go ahead.
Hello.
Rohan, please go ahead. Yes, please go ahead, Rohan.
Yeah, good morning. Thank you for the opportunity. First of all, I just wanted to congratulate on the milestone of hitting 100 branches. I wanted to ask about what kind of, how we should think the optimal branch footprint will look like over the next maybe year or year and a half, and what kind of AUM per branch can we expect, a sort of a steady run rate?
Yeah. So last year, in terms of branch expansion, I think we are currently at 100 branches. So we will be growing this number by 40 to 50% over next 1.5 years. Okay. So that will be, as per the that's as per the plan. But if there are other external factors which if there are any, then we will have to revise it quarter-on-quarter basis. But as of now, that's what is as per the plan. And in terms of AUM growth, so AUM growth will be also in the similar ranges which I mentioned already. Okay, in next 1.5 years, so it will be around 40 to 50% growth.
Okay, sir. And at optimal peak level, say after a year and a half or two, these AUM per branch will be similar to what we are clocking as of now with the mature branches. Is that correct, sir?
No. So basically, AUM per branch is not a right metric for a company like us, which is quite young. So as the branch matures, your AUM keeps growing. So the branches should be well seasoned to compare it with the industry. So our branches are will not be more than 3 years or 4 years. A more number of branches will not be on that vintage. So AUM per branch as a metric, we should not look at it as of today. We should only look at it as steady state. So whatever numbers we see is mix of most of the branches are opened recently, and some branches have opened like vintage is 2 years, 3 years. So it's a mixed bag. So that metric is not it's not the right metric to
not
look
the
at.
right way to look at it. Fair enough, sir. Understood. So just if you could shed some light on the operating leverages as the newer branches mature over the next few quarters, what kind of operating leverages can we expect in terms of expenses specific to when AUM grows, the operating expenses, the employee expenses? If you could give some color on that, sir.
Yes, sir. So as your branches mature, you definitely get you definitely get operating leverage there, and as well as the number of branches are increasing, your fixed cost as they are not increasing to that proportion of branches increase or AUM growth. So definitely there will be operating leverage kicking in, but to estimate a number around that may not be the right thing to do now. But definitely as the same store, the same branch grows, as well as the number of branches grows, both will give us operating leverage.
Also, just to add, these are very important metrics that we want to track probably in the long-term horizon, because as you are a very fast-growing company on a smaller base, these metrics do not show the true picture. So right now, if you see our OpEx to AUM or cost to income ratios typically will appear high because we are making upfront investments when it comes to branch expansion, right? So over the 5-year kind of a horizon, if you look at it, we will, of course, try to be better than our peers, if not at the same pace.
Understood. Understood. So that would be our target OpEx to AUM ratio, what the industry average is.
Correct. So OpEx to AUM is one important metric. Cost to income is another important metric that we analyze internally to understand, our progress when it comes to these metrics.
Understood, sir. Just one last thing, if you could give some light on this. You spoke of ticket size earlier. So, in terms of gold prices having increased over the last few months, do you see any change in, consumer behavior when they are borrowing against gold?
So consumer behavior is standard, so there is no change in the consumer behavior. But definitely, as the price rises, then the average ticket sizes will go up naturally because for the same collateral is now eligible for a higher loan amount. So that effect will definitely be there. But in terms of consumer behavior, in terms of availing loans and retention rates and things like that, so those things have not changed much.
Got it, sir. Thank you, sir. Just if you could close with some guidance for the year and the next year, that would be great.
So like we said, what we're focusing on is that we want to, now we are very confident of the base that we've created, whether it's the business or the process or the systems that we have in place. So the next growth will come obviously from expansion, and we are pretty much very confident about that. Like we said, our near-term guidance from the perspective of 1 year, we'll be in the range of AUM expansion should be in the range of 40 to 50%. Vis-a-vis branch expansion should also be in a similar number, so which is around 40 to 50%. So if you see last year we added almost 26 odd branches. This year our target is to add 50 to 60 branches as per our annual operating plan. But again, it depends on a lot of other external factors. There could also be a scenario wherein we are pretty much confident of basically extending this number to a higher number, which of course you will give some further guidance in the upcoming quarters.
Got it. Understood, sir. That's very helpful. Thank you for taking my questions and all the best.
Thank you. The next question comes from the line of Akash Sharma, an individual investor. Please go ahead.
Yeah. Hi, sir. Thank you for giving me the opportunity. I have a couple of questions. My first is, sir, that interest income growth has been strong, right, while fees and commission income has moderated on a year-on-year basis. So is this a conscious shift in product or pricing mix? And how should we think about blended yields going forward?
Yeah. So talking about the shift within increasing income, interest income, and declining fees and other income. So there is a shift or a change in strategy with respect to our PL product. PL product erstwhile that we used to offer was for a period of 30 days. So that was a high churning product, which is now being slowly transitioned into a 3-month EMI sort of a product. So that spreads out our yield, and that is why you see a lower fee income on that particular product, which is impacting the overall revenue growth. On the going forward basis, our idea is to move the entire PL book from a short tenure 30 days to a 3 to 6 months sort of a book, which fairly spreads across the overall fees income that we earn.
Okay. And so my next question is that finance costs have risen in absolute terms, with leverage moving up to around 1.678 times. So where do you see the steady state leverage settling? And do you expect cost of funds trend, to go down as the borrowing mix diversifies?
Yeah. So to answer your question in two parts, the industry currently is operating anywhere between your 3.5, 4x, and that is where we aspire to be on an on-book sort of an AUM. Talking about our cost of borrowings, yes, so we do expect some sort of rationalization in our cost of borrowings. So this is one financial year wherein we have extremely leveraged ourselves. Despite of the equity infusion in the month of May, we are still able to, make it to a 1.6, 1.7 sort of a number in terms of leverage. And, our current borrowings, considering our current external credit rating, has been, on the higher side. But as we, grow our AUM base, as we perform well, I think as the credit rating improves, I think all of this will settle down in an industry range.
Okay, sir. That helps. Thank you so much, and all the best.
Thank you.
Thank you. We take the next question from Mandira from Invest2 Investment. Please go ahead.
Thank you for the opportunity. I have a couple of questions. So, with your entry into NCD and co-lending leading to off-book AUM, how should we interpret the future mix between on-book growth, co-lending expansion, and balance sheet leverage?
Can you come again? Couldn't hear you properly.
Am I audible now?
Yeah, better.
Yeah. So with your entry into NCDs and co-lending leading to off-book AUM, how should we interpret the future mix between on-book growth, co-lending expansion, and balance sheet leverage?
So as I said, on balance sheet leverage that we target is somewhere about anywhere between 3 to 4x. And talking about our co-lending, so we are fairly new to co-lending. We are in a phase of partnering. You may see some sort of a traction in Q4 as well on the co-lending side. And with the revised guidelines under CLM1, we are yet to see that kind of a growth that we have been, keeping that as an internal target. But our target for the next year would be, to have a co-lending proportion of anywhere between 10 to 15% of the overall AUM. That's the co-lending bit. On the NCD side, we have a fairly fair mix of our banks, financial institutions, and NCDs, which is 2/3 and 1/3. And this is where, this is the proportion that we aspire to maintain in the coming years as well, anywhere between your 1/3, 2/3, or 60/40 sort of a ratio.
Got it. And secondly, so as co-lending scales up off-book AUM, how do operational workflow differs from on-book lending, especially across sourcing, servicing, and collection?
Yeah. So there is no major difference in terms of operations, whether it is co-lending on book or off book. So the operations remain same. The only difference is on the finance side and the cost of funds side. So as such, there is no difference in terms of operations.
Got it, sir. And last,
there's no difference.
Yeah.
So there's no difference in the customer experience. The customer, for him, it doesn't matter. At the back end, yes, because it's under CLM1 sort of a model, the partner also has to give a concurrence before we proceed. So there are certain, extra procedures that are performed quickly at the back end. But in terms of customer experience, there's no differentiation. Yes.
Okay, sir. And lastly, with a current ratio of 2.6 and a strong asset cover on NCD, is there a room to optimize liquidity further without weakening our balance sheet?
Sorry, come again. With the current ratio of?
With the current ratio of 2.6 and the strong asset cover on NCD, is there a room to optimize the liquidity further and that would not weaken our balance sheet?
Yes. So, see, on the current asset side, all our, assets that you see are current assets. The entire AUM, we do not have any long-term, products. So that in a way gives a lot of comfort on the overall current assets ratio and liquidity, because we also have a portfolio which is for a 30-day product, plus our cash position has remained strong across quarters. So we don't see with undrawn sanctions as well. So we don't see that as a challenge for coming quarters as well.
Thank you so much, sir. That was really helpful. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for the closing remarks.
So thank you for the thoughtful questions. So as this was our first earnings call, our objective, was to provide clarity on how we are building Finkurve. The principles that guide our decisions and the discipline with which we approach growth. We recognize that trust is built over time, and we view this call as the beginning of a more regular and a transparent dialogue with the investor community. Right, so thank you once again for your time and participation. We look forward to speaking with you again in the coming quarters.
Thank you, sir. Ladies and gentlemen, on behalf of Finkurve Financial Services, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.